Hey.
The crew from Paradigm Shift Financial. It's Thomas and Shauna. So, guys, I know I want to bring up all these charts, then you guys don't want me
Charts
to.
and graphs and numbers. Yay.
Stay focused.
But the thing today that we're really going to dive into is, and this is a big piece of what you guys are teaching, risk reward, essentially. When does it make sense to invest in certain things, other things not? There's a lot of common knowledge, I'll call it, out there, and I'd say we can set the stage with the common knowledge. A lot of people believe that when you're younger, you can be more aggressive with your investments. You can take more chances because you have time to catch up if you need to. And then when you get older, especially approach retirement, you should be more conservative with your investments. Now you've made your money, and you should try to protect it more at that point in time. And this is the kind of common knowledge that's out there.
That is what's taught, yes.
That's what's taught. That is not what you teach.
No.
Not what you teach at all.
Not what we teach at all.
And today we're going to talk about what you teach, and we're going to look at some numbers, and we're going to look at some data that sort of back it up, if you will.
Well, and then hold on, just as a quick disclaimer, you know, just in case the SEC watches us, every client is different, and their situation is specific and tailored to them, customized, right? But at the same token, we can demonstrate how being more conservative more often ends up with portfolios failing than staying more aggressive through retirement.
And so what you're saying is, don't stop being aggressive. There's no point.
Well, everyone has a personal risk preference, risk-return preference. So if they're super uncomfortable with a lot of volatility in their portfolio, obviously we're going to support them and still coach behavior, and the statistics don't lie.
There's that.
Facts don't care about your feelings.
Yeah.
Well, it goes kind of like, it's the idea of like the traditional investment space creates conversations where it's almost mandatory, it's almost assumed, like you said, common knowledge that, oh, I become more conservative as I get older. When you test that and you actually put the numbers to the concepts and look at, you know, what happens, it's more often than not, it doesn't work. So then the conversation is, okay, well, why, and this is how we kind of process. We're always
questioning. When you say doesn't work, what you're saying is doesn't meet the goal.
Well, if you run out of money, we consider that failing.
That's the failure. Okay,
right.
So the goal is to not run out of money. And so if by not working, what you're saying is you run out of money.
Yeah.
Yeah.
Right. The thing that you need to pay for stuff.
Right.
And live.
And
goes away.
Yeah.
Life doesn't seem to work so well anymore.
Yeah.
I mean, there's always the government, but come on.
See, that's tough. That's a tough situation, right?
Yeah.
Because now if you're in that spot, you really are not in a situation to be able to earn.
No.
And so you're kind of screwed.
My dad always says, he goes, "Don't count on inheritance, boy. I'm gonna have my last check bounce." And I always pull the line from Taken, you know, the guy on the phone. Good luck.
Wow.
Don't count on inheritance. That's what he said.
I haven't finished drinking my coffee. Sorry.
That's all right. That's great. You quoted Taken already. I mean, that took, what was the over-under on that? And we got there.
Yeah.
So, I mean,
well, conveniently, we're talking about how the industry takes people, right?
Right.
It does. I mean, there's no question about. I mean, here's the thing. We've mentioned it before. There's more mutual funds than there are stocks.
Yep.
Right. That makes no sense. If there is any value to these mutual funds,
right,
then that just couldn't be the case. It just couldn't be. There would be 4 or 5 of them, maybe.
Right.
10 tops.
Or if the argument was true that they somehow knew what the market was going to do better than the average person.
Yeah.
If that argument was true, you're right. You would see way less mutual funds because we wouldn't need that many people gambling, essentially.
And a lot of mutual funds are very similar to other mutual funds.
Yep.
There's tons of mutual funds that are very similar to other ones.
Yep.
So you have essentially this huge pool of stuff that is very difficult to decipher, but essentially they're all doing pretty much the same thing, maybe in some different sectors and things like that, but there isn't necessarily a specific philosophy that you are subscribing to with a mutual fund, which is what you guys are teaching. You're teaching a specific philosophy of investing, and this is one of those philosophies, which is you've got to make sure that it works, meaning that you don't run out of money. And with people living a lot longer, that is something that has to be put into consideration. A lot of people used to think that, hey, once you get to 55, 60, slow your roll, get into bonds or CDs or whatever the idea was.
Yep.
But if you've still got 40 years or
Yeah.
30 years.
Probably even more than you had to save in the first place.
More damn.
Yeah.
Actually, I mean, that's
Your
a
money
great
needs
point.
to last
A lot longer.
just as long as it has lasted since you've been saving it.
Especially when you're considering husband-wife, longevities of couples.
Right.
I mean, it's a 50-50 probability that someone lives into their late 90s based on current life expectancy
Yeah.
with a couple.
Yeah.
So if you retire at 65 and you projected to live late 90s, that's at least 40 years.
I know that the last time I looked at this, which was inside the last year, average lifespans, I can't remember which, I believe it was women had the longer one. It was 87 and 85 in the United States of America. 87 and 85 years old was the average.
Okay. Sorry.
That includes, all the people who are dying prematurely
Right.
from different things. So you're really talking about a lot of 90-year-old people, and then we have a record number of centenarians, people who are 100 plus years old.
Yep.
So if we just look at that and go, all right, we have to reset the calculation. The calculation is no longer, all right, I'm done with money at 75 or
Right.
70.
Right.
It's now we have to look at 90, 95, and that changes things.
Well, and consider that the life expectancy conversation is it's just the point in which it hits 50-50 statistically. So if it says life expectancy is 96 for women now, that just means that's the 50-50 point. So you look at where you get to the 80s, like the higher percentile chances, like 80% of people aren't alive, 90% of people aren't alive, that's in the early hundreds. Like, so it's kind of crazy when people look at life expectancy and you realize, no, it's just saying, hey, toss a quarter. Like 50-50.
And so in order for your money to not run out, for it to last that long, you need to stay invested longer in the markets.
That's what we're teaching, but that's not what's being taught by
Right.
others. That's not the conventional wisdom. The conventional wisdom is you get to retirement, you go wake more conservative. You buy annuities, and not, again, disclaimer, not that annuities are bad, but I'm just saying that that's the common knowledge is you go super conservative with your money, you don't take a lot of risk, you took it all when you were younger, and now you just live off of whatever the income your asset produces. And it just, statistics, numbers, everything that we look at shows that won't be effective for a long period of retirement.
Yeah, and it's not going to produce quality of life.
And we're going to look at some of that today, so
That's right.
whichever camera, stay tuned.
We're gonna start with just taking a look here at what's happened in the market recently. As I'm sure you guys have been getting a lot of calls from people. There's been
You'd be surprised.
some volatility.
This is part of the education piece. Is as people start to learn what's going on. We had a few calls, not
did.
many, but we actually had more people sending us like a text message or an email. Hey, great buying opportunity, right? It's because of
Yeah.
what we've taught them.
And then Thomas was, it's like, look at these people are learning.
I did do that.
Yeah.
I was like, this is all me and us.
Yes.
We did this.
Carrie, pull up the chart there.
It's either that or we don't have many clients.
The Dow Jones. So you can see there. This is the 3-month on the Dow Jones, and it was kind of just steadily marching up over here. And then we've had some volatility. So we've had some down days. We've had some some technical thresholds have been met. It's great stuff for the CNBC shows.
Oh, yeah.
Right?
Oh, yeah.
It gives them something to talk about. Oh, the Dow's down 500 points today. It's down this much. We saw yesterday in the real estate space where I do a lot of work. Zillow is down 26%
Yeah.
in one day
Yeah.
when the market was up 500 points. So I think it gets a lot more people paying attention, which I think is good, especially for the education that you're trying to provide for people and that we're collectively trying to provide here. More people are paying attention. Oh, okay, we've seen down days, and we saw, if you go back, let's see if I just do like a 1 year here. In February we had that flash crash kind of thing right there. That was wild, right? And there's been, there's some volatility. Then we just sort of marched back up, and then we've seen some more. Which this is all normal. You don't see straight lines in stocks, but
If you do run, it's a Bernie Madoff.
Yeah.
but the last you got to admit too, though, since 2009 we've seen a lot of updates. I mean, we've been up tremendously. So when people start asking you about the charts and what's happening in the market, I mean, what do you think? What do you say right now?
Stop.
And?
Stop it. Right. Stop it right now.
Stop what?
That's what we tell them.
Yeah.
Stop what?
So what do you think? You ever seen that? I'm a meme guy.
Yep.
It's got that like Robin that's he's starting in the middle of a sentence like asking Batman something, and Batman slaps him across the face and just says no. What do you think we should do with the market and the current administration with being invested in international? Isn't that going to be bad? No, right? And then we show them the history, right? Again, it's always about education. You look at people are freaking out. International is down. We talked about that, right? Yep. People were freaking out about that, but you look at the last year, every single international market was up more than the U.S. market. The worst performing international market was over 2% more than the U.S. markets. From 2000 to 2017, the cumulative return of the S&P was 157%. By comparison, the emerging markets was 610.
Wow.
Vast difference, right? So you can't base it on 1 year. You can't prudently invest basing on any one asset class over a year period. Then you're doing what's called market timing. And you want to look at a fun statistic. You guys can pull this up on your own, but there's a research piece that shows the average return for the last 16 years of the S&P was around 9.83, something like that. If you missed the top 25 days, just the top 25 days in that span, your return would have cut in half. You would have only got 4%.
So you have to be invested to get that.
Right. So you're trying to tell me you think you can market time where if you miss the top 25 days in a 16-year period, your return gets cut in half? Good luck.
That's going to be tough.
Yeah.
And the media is always playing on your fear, even when the market's up. They're talking about the fear of the market going down. They did the same thing before Trump got elected. Oh my God, we're going to have a market crash. Everybody's going to freak out.
It's not an endorsement of Trump, by the way, just for
nothing happened.
We're apolitical. Anyway.
But the market has been up.
Yeah.
And it is up. And I believe today might be not up as much, but here's one other thing I brought up.
Remember, a market is up.
A market. Yeah, true. So this is one. Let me see if I can get this framed properly here. Yeah, there we go. So this is the VIX, the volatility index.
Oh, that looks awesome for Six Flags.
My God, right? That's investor's heart rate right there.
Here's the end of 2018.
Panic.
Yeah, it is. That's exactly right. That's kind of what it is. Here's, kind of it was very calm and quiet, at the end of last year, and then, the flash crash stuff got us jumped way up here to 37. And it's been more volatile. Mm-hmm. But again, this is something that when I asked you if we want to show this, you were like, why? Who cares?
Right.
And I know people do look at this.
Oh, yeah.
And they do care. Maybe they're wrong, but I know people care. They're noticing, gosh, there's volatility in the market, and it in the past we've seen like volatility build up, big swings can happen.
Yep.
And so that's what people are talking about right now.
Yep.
But you guys don't care.
It's not that we don't care. It's that we're armed with enough knowledge and enough expertise to know that that's not important, right? It's not that I think it's important to frame that. Like, we joke around, we have fun, but it's not like a client has a concern, we're like, don't be stupid, right? We understand their concerns, and we identify and empathize with it. And the reason why we don't allow it to cause us to waver is because we know the academics. We know what history tells us.
Yep.
And so client brings up something like that, we show them the last 100 years and go, okay, what would you want to have done, right? Or like we talked about, 2000 to 2017, the drastic returns in the different markets, even though one of them's down right now.
It's a good point you bring up, because a lot of people, even if you start investing when you're in your 30s, if you're going to need the money until you're 90, you're talking about 60 years of being invested.
Yep.
So you really do need a long-term game plan.
Yep.
There's no real short-term game plan. There's a lot of people who are, unfortunately there's, I call it the Scott trade syndrome, which has come about, by the idea of cheap trades. It used to be that if you wanted to trade a stock, you had to call a broker and you had to pay a pretty hefty commission. So people didn't do it that often. They were sort of incentivized to just hold on because it was so expensive. And then Wall Street sort of removed that barrier, that cost, and said, no, we'll make trades really cheap. And you see some even big box brokers now offering, say, your first 100 trades free, or things like that. Almost like they're encouraging people to go gamble.
Yep.
Not just adults, children too.
E-Trade baby.
Yeah, well, there are companies that go into schools and they play stock picking games.
Oh yeah, the stock
It's
market.
like they're programming them while they're young.
You know, they actually do that in high school.
It's crazy.
I remember playing it. I sucked at it, so it makes total sense that I do what I do now.
I wonder why they did. I have to actually ask my dad. My dad's a mathematics teacher, and he said that he taught a class one year on. They asked him to, like last second, to teach a class on stock investing. He's like, I didn't know anything about the stock market. They asked me to teach a class on stock investing. One of the things they did was pick stocks
Yeah.
and see what happened.
Yep.
One of the presentations or the webinars that we do, we have what we call the stock picking game, which all we do is look at 4 markets, and we ask people to guess what market did what, and like they get like 3 of them out of a 20-year period maybe, and it's like you just can't. It's not possible to consistently long-term predict what's gonna happen. So the fact that they frame it that way, like one of my favorite commercials was an E-Trade commercial where this guy sits down in an airport. It was like he sits down in like an airport, just the waiting area. I forget what the hell they call it. And he looks up and he sees like a coffee shop. He's like, furrows his brow like, He pulls it up online on his E-Trade and he looks up the ticker symbol and he buys it and they're like, follow your hunches. And I'm like, no, that's a horrible idea. Like, what?
He just saw a coffee shop in the airport and he bought the stock?
Yes.
That's amazing. That was their commercial?
Uh-huh. Yeah.
That's just, it's basically, okay, well, let's be honest. Let's just talk
Preying
about,
on people.
yeah,
It's
let's
like
talk about the
lottery.
stock market.
People play the lottery because they think they're special and they're going to win.
I'm going to win it at some
And they
point.
think they're going to win when they purchase one stock.
You ain't going to say shit when I got billions of dollars from my lotto winnings. I
Okay.
ain't sharing.
Good. Write it down. I don't care.
I can't look this way. She's going to hurt me.
Here's the problem with gambling. And let's be honest, it is gambling.
Yep.
Yeah.
Stock picking is gambling. You could say it's educated gambling. For some people who are really looking up a lot of stuff and feel good about what they're doing. But there's no way, no matter how much research you do, to remove the fact that it's gambling, because you can never know more than the market does.
Nope.
It's impossible. No matter how much you research, no matter how on top of
Right.
it you are, the market knows more than you do and knows before you do. And there's no way around that.
Right.
So regardless, it's gambling. And gambling hasn't been legal everywhere except for in the stock market in the past 100 years.
Yeah.
So this is one of those things that because of the easy access, I think a lot of people are frankly just pissing away money. Not just by doing something that they wouldn't have to mess with. In other words, they're spending time and losing money.
Yep. Well,
So it's a double whammy.
It's also because they're not aware. Like, if we're really blunt and clear about it, would you gamble, right, if you were really aware and really, like, you fundamentally understood that markets have presented and provided, just being invested in a market? Like the S&P 500, let's just use that. It's a horrible example, but let's use it. If you invest from 1926 to 2017, it's averaged for the whole time over 10%. Like, if you really fundamentally got that just by following along with that, you could produce 10% with no effort, really, just being a part of the market, would there be a necessity to gamble?
I think for some people there would, unfortunately.
For the
I do.
majority, I mean.
Okay.
There are going to be the people that are like, I can get a 30%. I need to go for that.
Yeah.
Well, you have that. You also have,
What about pot
the Jim Cramers out there. Yeah, the pot stocks. There's the Jim Cramers out there who are naming stocks every day. And one of the things you have to realize about these shows where they talk about stocks every day is that every day they have to tell you that to buy stocks. So every day they have to go and look and say, how can I sexify one of these stocks so that it makes sense for me to tell you to buy it right now? They have to tell you a stock to buy every day.
Yeah, Jim Cramer wouldn't have a show if we did. I mean, pretty much, we've been on your show for what? Since February? Almost?
Yeah.
That's it, yeah.
What is that?
6, 7, 8 months.
8 months. And we've said the same thing every time. It's just different. Right? It's like, don't gamble. Don't gamble. Follow the market.
Stop throwing your money away, basically.
Right.
And your time, too. I mean, that's the thing. A lot of people who are doing these trades, and I had a really funny conversation. It would have been amazing if you'd been there on Halloween with some of the dads. My daughter went to a big Halloween party, and the dads were all talking, and they're all trading, and there's, I do about 35 days a year, I trade the whole day, and whatnot. And
Did anyone talk
fluent
about
guys.
when they lost a lot of money?
No one ever likes to talk about that. I think I'm the only one who has actually broadcast the days that I really just gave away a bunch of money.
Yeah.
I really, really took it on the chin. And this is before the during the crash period last time. I have hilarious stories about buying stocks at 30, selling them at 11. The next day they're at 20.
Yeah.
I mean,
It's always like they do it. It's almost like it's targeted just for you.
Yeah.
It feels that way.
Yeah.
It really does, especially first Marblehead. I mean, that's one I'll never forget. And then Washington Mutual was the other one. I convinced my partner, said, let's buy this. It's $2. They're not going to go out of business. Literally the next day, the first thing I saw was a headline: Washington Mutual, declares bankruptcy or whatever. Literally the next day.
Yep.
So I've got some great stories of learning this lesson.
Yep.
And that is why, and you guys know, my thing. And I agree, you should be invested. You should stay invested. Don't try to time the market. Making consistent, I think it does make sense to consistently invest in the market. So not to throw it all in at once.
Well, I think
but to say, hey, let's dole it out.
I think anybody who's watched all of our shows thus far, or even a few of them, have potentially gotten clear on the idea that it's not predictable. You're not going to be able to beat market returns over a long period of time, and hopefully gotten clear on the fact that market returns that have been provided and are available are amazing. I think the one thing that, and the idea behind the topic today, and the one thing that most people, even if they are clear on that, haven't ever gotten clarity on is, why do they say to be more conservative as you get older, and how does that actually work? Like, what are some actual numbers on does that work out for me?
So I've got this graph that you guys sent over. If you want to pull it up, Carrie, there. Let me see if I can zoom in. We can see it a little.
Whoa! Don't go there yet.
Don't go
It's
here
a lot
yet.
of numbers. Yep. Don't go to that one yet.
Well, I think the rest is just words.
No, it's not. I promise.
This one?
Let's start. So this is one of those things that we run for clients for them to see, right?
Yeah.
So the first page, the words, I think it's just important to go there for just a second.
Lots of words.
I know. So scroll down one. Yeah, so this is just, again, just from a compliance standpoint, just a disclaimer that really walks through and talks about that each person's situation is different, but it also explains how we arrived at what we're going to show, right? So it'd be one of those things, if someone wanted one of these, wanted to be able to read this more, they'd be able to have access to it in the future. Right?
We can offer people to send this to them, right?
Perhaps.
Okay.
He's going to pimp us out again here.
Trying to give our shit away for free again.
Isn't that what you want?
No.
What do you want?
So before we go into this, I just think it's important to show, if we can just do live real time before we show this, just live real time, that Monte Carlo simulation.
Okay.
And the only reason I think it's important to show that is because this is how in the past with our old firm,
Yep.
I used this to kind of, I'm not going to say be a dick, but
You just did.
but to trip up other advisors,
Okay.
to get them to start thinking a little differently about how they were presenting this information that's just regurgitated. So I kind of want to walk through it the same way I'd walk through it with them,
Okay.
to showcase that. So if you can pull up that calculator,
Yep.
we can just do it live, real time, real quick, and I'll show you what to point out.
Okay. Got
But
it.
you can find this online. You
Yeah.
can search for any Monte Carlo calculator online.
That's the other reason we thought to start with this, is because you can actually just do this on your own. Like, a client can just go to this website and just do it on their own and test what we're showing.
Okay.
So here's the two things to change. See where it says 40,000?
No.
Right in the middle, withdrawal.
45. Okay.
Oh yeah, 45, sorry. Can you just change that to 4,000?
4,000.
And then
Okay.
where it says annually, just change that to monthly.
Annually withdrawal frequency, monthly.
Yep.
Okay.
Let's see, inflation adjusted, yes, that's a huge important piece that most people don't talk about. Historical returns, might as well just use what markets have actually done, right?
Sure.
Bootstrapping, we don't need to worry about that. Just scroll all the way down to the bottom. Sorry, not all the way down to the bottom. Just right there where it says asset allocation. See the little wheel? It's got the settings, right? We're just going to do what's called the lazy portfolio. So click on it and just click the growth portfolio.
Okay.
So what this is illustrating what we're going to be looking at, what a Monte Carlo does, is it's going to take the build out of what a growth portfolio would look like, the historical inflation, and the historical returns. Oh, one other thing to change, because we just talked about longevity. Scroll up a little bit. Where it says 30, just change that to 40. Let's assume 40 years in retirement.
Okay.
Because that's a possibility.
We're blessing everyone with a long life.
Right, exactly. It's a possibility. Right. And the longer the portfolio lasts, the more burden, the more strain on it. So what this is going to do is it's going to produce a multitude of calculations of actual historical returns. So it's not going to be at the same time. Like it's going to say, all right, if we had a negative 28 in 2008, maybe we move that to 1977 and see what that looked like, right? And it's going to shift up how those returns occur, but it's going to take all of them and give us a percentage success rate. So with these numbers, with that distribution, with inflation, what's the likelihood that this portfolio succeeds? So if you scroll down and you click Run Scenario or Simulation, so they give us a lot of numbers and whatnot, but there's one part that's really important to focus on. If we scroll down a little further, it's at the bottom of the summary, right there. So 7,100 out of 10,000 simulated portfolios succeed.
Gotcha.
See that?
So depending upon your
It
entry
doesn't run out
point,
of money.
etc.
Right. So it ran 10,000 different combinations of historical returns. And what it's saying is an aggressive, like a growth-oriented portfolio for 40 years through retirement, taking $48,000 a year and inflation adjusted off of $1 million, has a success rate of 71%.
Okay.
So I would show this to advisors at the old firm, and I'd be like, so what do you guys think about this? And they'd say, well, that's the reason you're having that. The problem with that is it's too aggressive. I'm like, well, what do you mean? And they go, well, it needs to be more conservative in retirement. Like, that's what we talk about. The reason you're having such a struggle with the success of this portfolio is because it needs to be more conservative. I said, okay, so if we switch to a conservative portfolio, what do you expect that number to be? They go, well, 80 or 90 or maybe even 100. And so this is where be the trap, right? I go, okay, let's do that and test it. So if you go back to the simulator, go back to the lazy portfolio, and just click, I mean, why don't we just say income portfolio? Because that's what most people talk about.
Okay.
Yeah. So even an income portfolio, look, so that build out right there, 13% US stock market, 7% global stock market. So you're still 20% invested in the stock market with a income portfolio.
Yeah.
Based on this simulator.
Yeah,
right?
they have global exposure here too.
Mm-hmm.
Right. So now let's see what happens if you listen to mainstream advice and you went conservative, pulling out that kind of distribution. Scroll down to that summary number.
Wow. Less than 50%.
Yeah.
That's crazy.
Completely flies in the face of the traditional advice.
Completely.
So
that's a drastic difference.
That's a drastic difference. 71% success versus 49, almost 50% success. Wow. So then you have to ask. This is why I would say would be kind of a dick, because it would trip up every single advisor. It'd be like, wait a minute, wasn't that number supposed to be more? What happened? Like, did we do it wrong? Did I break it? Like
That is not the high score.
That's not the high score, guys. So you got to consider.
You're also assuming with the the previous model that everyone stays invested.
Right.
Right. That's very important, because that's what this model is showing. You're staying invested. You're not missing any of the good days.
Right.
All that stuff.
Right.
You're not panicking. Exactly.
Well, and that's so you tangenting that way is perfect, because you got to then consider why isn't, if this is the case, right, where you can run this time after time after time after time and it's going to come out like this. Why, if that's the case, does everybody innately know, because the industry has been telling it, that it's better to go conservative? And so what I would submit is what you just said, is that it's easier to pander to people's fears and it's easier to coddle behavior than it is, and to sell something, than it is to go against the mainstream, go against what people are naturally inclined to do, and to actually coach them on their behavior so they could produce the other result. So
100%.
it's so much easier to just say, I mean, that's our standpoint on why it's mainstream, is it's so much easier to go, well, we know that you'll end up with more if you're more aggressive, but we're not going to take the time to work on your behavior. So we'll just tell you to go more conservative. Oh, and since we're going to go more conservative, what we'll do to make it successful is say that you should take less money. And what we'll do to make sure that's successful is say that if you're going to take less money, you might as well get a tax deduction for it today. So fund your 401ks, max out the tax deferral today, because you're going to have less in the future, because we're not going to talk to you about your behavior. So you might as well pay less taxes on it.
And that's what's happening.
Yeah.
That is, you just described in like 30 seconds exactly what's happening in the marketplace.
That's how we unplugged from the Matrix. That's what just happened. The live viewers right there just...
Are you more Morpheus or Neo, do you think, in this situation?
I feel like Shauna's Neo, and I'm more Morpheus.
My mother was doing that the other day from the Matrix when he's ready to fight, you know?
My favorite was the flip out choke when he like stops the punch. And he's
Yeah.
That was my favorite. That was like the greatest fight scene ever, and that's the weirdest thing that has ever been done. But it only makes sense in the Matrix.
Yeah.
That would be a move.
Yeah. And I mainly say that because I know that I would end up being the one captured because I'm slower and fluffier, and she'd have to come save me. That's why she's that's the main reason.
And you're Morpheus.
Yeah.
Okay. Well, let's put it this way. If you want to unplug from the Wall Street Matrix, you can at any point in time. Whoa. It's something that you are willingly and voluntarily participating in. But you don't have to. You don't have to. It's not that this way is more expensive or there's some gotcha or something that's like, oh, well, what's the catch? There's no catch. It's just following the stuff that actually makes sense. Like we just showed you the numbers. There's a taste of it. If you want to get more, you have to talk to these guys directly. Paradigm Shift Financial, Thomas and Shauna, thank you guys so much for coming in today. Really appreciate it. This is mind-boggling stuff. You really just blew my mind with that one. I did not expect it to be that drastic.
Right.
I did not expect it to be so much worse. I mean, that's 28% worse if you just look at the ratio between the two of 72 to 100. That's dramatically worse for someone who thinks that they're being safe.
Yep.
And that essentially is they're being sold a lie.
Yep.
Yeah.
And people don't know any better. And I think about my grandpa and grandma and people like that who are listening to people who are telling them this and believing them, and they're putting themselves into this meat grinder, and that is a shame. But let's have it. Let's call a stop to it right here, right now.
Do we have to?
Yes.
Well,
we're
I was just going to
unplugging
say,
from the
remember
Matrix.
that only dead fish swim with the stream. So
Oh.
go in the opposite direction.
Dang. And that's a mic drop.
Is that a
moment.
Canadian
That's-
proverb?
The Canadian.
It is now!
Canadian.
There are lots of salmon up there, you know.
You guys are great.
All right.
Share this video. Make your friends smarter than everyone else. See you soon.